Hello everyone, my name is Shivram Reddy Pakala, and here we are representing Group 9. And we have 5 members of a group, Kartikeya Paba, Rizwana Hamid, Margaret, and Siddharth with me. So today, me and my teammates are going to talk about the biggest collapse of long-term capital management in late 1990s. Here, this is such an important topic to talk about because it contains a lesson that every financial person should know. Here, the long-term capital management was a hedge fund and it was widely successful when it was started in the year 1994 by John Meriwether to exploit market pricing discrepancies. From that point onwards till 1998, they have managed $29 billion in assets and borrowed around $124.5 billion in debt. Where, but they have also achieved a high leverage ratio, which was 25:1, and significantly, they were the higher who was competing everyone in the market in the market of hedge funds, and they have generated immersive returns, which was from the past 3 years where they have started, which was 21% in the first year and 43% in the second year, whereas coming to the year 1996 it was 41%, which was showcasing the successful strategy of whole world. Whereas the market has started collapsing from here after the 1997 Asian financial crisis and the Russian sovereign bonds, which also caught the default from the August 1998. The asset fell to $2.3 billion to the market turmoil, whereas by September 1998, the equity dropped to $600 million, pushing leverage to 250:1 sustainable levels. And here, the main types of risk in LTCM's collapse is the market risk, liquidity risk, credit risk, and the operational risk. Whereas the market risk involves the potential financial losses from adverse marketing movements, LTCM faced heavy losses when volatility increased. So here, the liquidity risk is the inability to meet obligations. LTCM solid illiquid assets during the crisis amplify losses. And here, the credit risk arises from a borrower's failure to repay. LTCM suffered massive losses when the Russian default collapsed asset values. So here, these particular points also has made a good point over here in the operational risk, which involves the losses from inadequate process and errors. LTCM underestimated extreme market events due to complex modules. In these key factors, we have the leading to LTCM's collapse, whereas the excessive leverage ratios and the LTCM has amplifying the rising losses significantly to the global economics, and the environment was volatile towards the LTCM's trading strategies and the stability. Lack of the responsiveness and the firm governance structure was also leading to slow response to market changes. The correction of positions, LTCM has concentrated positions that increased risk exposure during the market downtrend, whereas the flawed financial models relied on assumptions that did not hold true under stress, leading the miscellaneous. Whereas these particular parts are explained in the quantitative analysis by one of the teammate, Siddharth.
Hello. So here, my name is Siddharth, and I'll be walking you through the quantitative analysis part of the LTCM collapse. Here, I have explored how market behavior, model assumptions, and leverage contributed to the most significant hedge fund failures in history. So, for the first part, here is a chart describing the time period in which the LTCM faced huge losses. The output shows a clear decline and increase in volatility in the S&P 500 during the LTCM crisis period. This pattern corresponds with the financial turmoil triggered by Russian debt default in August 1998 and subsequent collapse of long-term capital management. The chart captures the panic and liquidity issues in the market, setting the stage for a more detailed examination of losses during the crisis. Here is the chart showing the daily loss patterns reflecting the crisis severity. Noticeable spikes in loss data during mid-1998 indicate days of significant negative returns. These spikes reflect the heightened market volatility triggered by LTCM's collapse and surrounding financial turmoil. The plot underscores increased downside risk for the S&P 500 in reinforcing the severity of the impact on S&P LTCM prices. First, for the data I have tested for normality, the Shapiro-Wilk test is applied to the losses, yielding a p-value which is significantly lower which which is a strong evidence for rejecting null hypothesis. The S&P 500 losses during the LTCM crisis period show clear signs of non-normal behavior and with fat tail and skewness. This reflects the extreme market conditions of 1998, where large losses occurred more frequently than normal models predicted. LTCM's reliance on normality led to the underestimated risk and contributing to its collapse. Next, next what I did was test VAR, assuming the data is normal, and in a 99% confidence level. The VAR estimated to be 2.5% means that under normality, there is a 1% chance that the daily loss exceeds 2.5. The 2.5 might seem reasonable for typical market conditions. The rejection of normality suggests this estimate is unreliable for the LTCM crisis period. The normal distribution underestimates the probability and magnitude of extreme losses, a critical flaw exposed during 1998 when markets experienced unprecedented volatility. This underestimation mirrors the shortcomings of LTCM's risk management, which failed to anticipate such tail events. Here, to model the tails more accurately, we applied extreme value theory with EVT. The 9% VAR jumps to 4%, and expected shortfall jumps to 5%. This better reflects the severity of the rare market condition. EVT estimates 99. The LTCM's reliance on normality likely underestimated tail risk, contributing to their collapse during the market stress period. Next slide. Here we are looking into how leverage has affected the LTCM's financial crisis. They operated with an extremely high 25:1 leverage ratio, magnifying both gains and losses. Even small market movements resulted in outsized losses, especially during periods of stress. Risk models underestimated tail events, making LTCM highly vulnerable when real-world volatility struck. Liquidity dried up during this crisis, preventing LTCM from unwinding positions without further losses. The scale of leveraged positions posed a systemic risk, triggering a Federal Reserve-led bailout to avoid broader market collapse. Thank you.
Oh, it's me, Rusmana. I will be taking about one of the major factors that contributed to LTCM's failure, their excessive use of leverage. Let's discuss and understand how the risky strategy led to massive losses for the firm. In 1998, long-term capital management, that is LTCM, faced a huge financial disaster, and one of the main reasons for this was their use of excessive leverage, essentially borrowing too much money. So leverage is when a company borrows money to make bigger investments than it could with its own funds. While leverage can increase potential profits, it also increases the risk, especially if things go wrong. For LTCM, the risk become a reality. LTCM used a 25:1 leverage ratio, meaning for every dollar of their own money, they borrowed $25. In simple terms, LTCM was making huge investments, borrowing 25 times more than they actually owned. This allowed them to make large speculations on the market, with hope that small price changes would bring in big returns. If their speculations were right, they could make a lot of money. However, if the market moved against them, the losses will also be massive. This high level of borrowing left LTCM very vulnerable when the market unexpectedly crashed during the Russian financial crisis in 1998. LTCM's mass debt made it impossible for them to recover. With such a large amount of borrowed money, even small market changes could result in huge losses that LTCM simply couldn't cover. They didn't have enough of their own money to absorb their losses, and their investments quickly became worth far less than the money they owed. The problem with the 25:1 leverage ratio was that it created a very thin safety net for LTCM. When things went wrong, there was no space for them, for the firm to absorb losses without facing a financial disaster. They were relying too much on borrowed money, and when they when the market didn't behave as they expected, they quickly ran out of the option to fix the situation. As these losses grew, their ability to borrow more money dried up, and they faced a full-blown collapse. And in short, LTCM use of such high leverage was a major factor in their downfall. So they had taken on too much debt. When when the market turned against them, their strategy backfired. The collapse of LTCM serves as a warning about the danger of borrowing too much money and relying too heavily on risky investments without enough safety measures in place. It's important to strike a balance between taking risk and managing potential losses, especially when using leverages. So now I pass it on to Karthik. He will discuss the prevention measures to mitigate such risk in the future. Thank you.
Hi, my name is Karthik Pabba, and I'll be speaking about preventive measures that could help avoid another financial collapse like what happened with LTCM. To prevent such failures in the future, financial institutions need to improve how they manage risk, especially in unpredictable market conditions. First, the risk models need to be stronger. LTCM said, use something used called a value at risk times, but not during a crisis. That's why tools like stress testing and extreme value theory are important. They help us prepare to rare but severe events that with simple models can't predict. Second, we need better governance and oversight. One of the LTCM's biggest issues was that no one was really questioning their risk strategies. In the future, firms should have independent risk committees that monitor risk and step in early when things get risky. Third, managing leverage and liquidity is essential. LTCM borrowed too much and invested in assets that were hard to sell. When the market turned, they couldn't exit those positions without major losses. So, firms should set borrowing limits, perform liquidity, stress tests, and keep extra capital as a backup. And finally, we need smarter hedging and diversification. LTCM placed all their bets in one direction, diversifying across the different assets and markets, and actively hedging against losses can reduce risk and improve stability. In short, better models, stronger oversight, controlled leverage, and smarter strategies are key to preventing another LTCM style collapse. And thank you.